GM. GM, 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 GM. Daily levels. Let's take a quick look. I'm long Bitcoin, and mainly based off this nice bounce off the lows into a consolidation right below and around the bands. Once the bands get close to crossing, we should see a squeeze higher. We've seen obviously, so on the way down we've had a one-way directional move from 49 all the way down to 38.6. No bounces, so shorts will have been building up. Shorts will now have to cover. I talked about all this yesterday, and just the normal reaction of the market is that it obviously doesn't go down in one direction. It's now starting to squeeze into an area where it should push higher. It's pushed into the bands before, but as trends develop, the bands are supposed to hold in a trend. So a 4-hour trend, bands held the first time, we broke down again. Bands held again, we broke down again. Bands seem to be holding again, but obviously that's not how trends work, right? Each leg you go lower, and each time you come back and retest, whether it's bands, a support resistance, whatever, the odds of the trend changing increase. Right? So it's far more likely now that we go up than it was over here, than it was over here. And so once these bands get tight and cross, you should see a pretty solid move up to about 42. 42 is where I'm going to target. For my trade, I'll be trading it short term, trading it long side, sizing up as much as I can, and just trading the 42. I think we can go to 43, 44, maybe even 45. But that's not what I'm interested in. Especially today's Thursday, tomorrow's the options expiry, that's Friday, 8 a.m. UTC. And there's a big wall of open interest at 42, which just in very simple terms means if price closes tomorrow 8 a.m. UTC at below 42k, all those calls, all those positions where people were betting long, they expire worthless, which is obviously good for market makers and for those selling the options. So I think that it's unlikely that we're above 42k at 8 a.m. tomorrow, but once that's passed, we can go anywhere. That OPEX is done, price could push higher, but I think we can push up today in the next 12 hours or so between now and the daily close. And then if we do hit 42 now, today, or overnight tomorrow, I think we just end up back below it going into the expiry. Depends. It depends on a lot of things, right? Options, open interest and options positions aren't fixed. They can be traded. So people could roll it. Rolling it is where you take your option, you roll it over to the next month. They could close it prematurely, right? People could be closing those options positions, selling them essentially based on the fact that they don't think we're going to go to 42, whatever. There's a whole bunch of reasons. It doesn't have to act as a resistance. It doesn't have to act as a magnet either. But the way a price is moving is very, very similar to how a typical move down would be. We've had 3 pushes. We've technically had more than 3, but I would class this as the first push, this is the second push, and this is the third push. Even though, here was a push there, and then went lower again, and then there was a push here, and then went lower again. But as an overall structure, you can see it quite clearly. Push 1, push 2, push 3. So a reversal is in order of some description. I don't know where to, but that's why I said 42 for me. And we'll see where it goes from there. Overnight, the Fed have discontinued the bank term funding program. Oh no, liquidity's gone. So as you can see just from the comments, how will underwater too big to fail banks survive? If they can't do this, it's game over. You can't taper Ponzi. Too much public scrutiny. The day it becomes a permanent bailout. Liquidity issues on the horizon. Let's see which financial institution will blow up next then. They shouldn't have started this foolish game in the first place. Most people, there are some smart people here who are saying you'll just cut rates instead. Correct. Surprised you didn't kick the can on this. They still have a year to pay them back. Absolutely correct. So there are some people who are awake to this. The simple answer is, this is the Fed saying they're going to do something, but then doing the opposite. So the reason the BTFP is being discontinued is because it's being manipulated, right? It's being gamed. In a really short, in really simple sense, the Bank Term Funding Program was announced last year in March during the banking crisis. You all remember the banking crisis, I'm sure. That was when USDC depegged and went down as low as 85 cents, and everyone in crypto freaked out. That's when Bitcoin dropped from a high of 25 all the way down to 19.5. But then, of course, we saw the V reversal as the liquidity issues turned out to not be systemic, and the Fed, of course, stepped in and said we're essentially propping up the markets. The important part with that is the BTFP is supposed to be a facility to allow banks that are struggling to access liquidity. But if you actually read the terms, which when you click through, this is the term sheet of the BTFP. And what it says, the borrower eligibility, borrower eligibility is any US federally insured depository institution. Any. Not a means tested, right? It's not if you're a depository institution and you can prove that you're in financial stress, you can access this. No, it's any. So any bank, any savings association, any credit union, any US branch or agency of a foreign bank is eligible to borrow under the program. So all of them. So what's been happening, because this is how incentives work, obviously, is that the ones that aren't in any trouble are arbitraging this. Because what it allows, it allows them to borrow at a rate that would otherwise not be possible. Essentially, in really simple terms, this allows any bank to borrow super cheap using either good or bad collateral on their balance sheets, which is not marked to market, it's not marked to the current price, but it's marked to the price of the value of it when they purchase it. So generally it's bonds. The reason this whole shit show came about is because the Fed in 2020 with the COVID printing essentially forced banks to buy bonds from them. But they bought bonds from them when the interest rates were zero, so they were not worth much. And then the Fed jacked interest rates up to 5.5%, which means the same bonds are yielding far higher, but that means the value of the bond goes down because bonds are inverse. The yield of a bond is inverse to the price. And I know this might be confusing, so in really simple terms, the Fed fucked over the banks by making them borrow at super shitty prices, right? Bought bonds, with a very shit yield, with a low yield. Then, as interest rates rise, those bonds get less valuable. Because if you own a bond that yields 1%, and then the Fed raises rates to 5.5%, why would anyone want your bond? Your bond is now it's still yielding 1%, right? But someone can go out and buy a new one for 5 and get 5.5% yield. So if you want to sell that bond, how can you? Nobody wants it. So you have to sell it dirt cheap. And it's just like if you bought Bitcoin at 40k and then it dropped to 20k, you've lost money. If you need liquidity and you're struggling and you need to sell, you have to sell at a loss. So that's what these banks would have to do if there was such thing as a fair system, but there isn't. We don't have a free market. We have a completely corrupt market. And so what the Fed did was they allowed a few of them to fail. Signature, Silvergate, Silicon Valley. And then they stepped in and said, oh, okay, we let these shitty ones fail, but we're not going to let any more fail. And so they said, all right, here's what we can do. You can use the collateral of those shit bonds, not at the current price, not at the market price that they would be, but at the price you had them. The value they were on your balance sheet before realizing the loss. So you don't have to realize the loss. You can take those shitty bonds as collateral, ones that are HTM, which is hold to maturity. And essentially what they're saying is, because you're going to hold that bond until maturity, when it will yield its 1%, 2%, 3%, whatever, we'll allow you to borrow dollars against that if you need liquidity. Which they do because there was like a mini bank run, right? People are like, fuck this, I want my money back. And so it's all a big scam. Now, politically, this is really toxic because people can see this and see not only are there banks that are struggling, but any bank can borrow from this. So, and because of the way it works, they're getting this collateral. You can see here, the collateral valuation will be par value. So it opens up an arbitrage, and the rate is a very low rate. And in essence, it's allowed banks that aren't struggling to come in and avail of the same facility to access liquidity and make free money. That's what arbitrage is, right? You take, there's one price for an asset on one exchange, there's another price for the same asset on another exchange, and you buy on one, sell on the other, and the difference in between, since it's the exact same asset, you collect. It's something basically the same as that, right, in simple terms. And so the reason they're